right, it's in chapter 4. We talked about the income. Remember, we're following along the format of the Form 1040. We have two different classifications of deductions. We have adjustments and we have deductions. The adjustments, they're called adjustments because they adjust our gross income. So these are kind of special classification. We've already seen in a couple of instances how adjusted gross income affects other items on the tax return. We use that adjusted gross income number to determine whether or not we receive other certain credits, determine whether we're in a phase out range for something or not. Like that, we used it when we were calculating the interest, the savings bond interest that would be excluded. Remember, only individuals under a certain adjusted gross income are allowed to then deduct interest if they use that interest for allowed to deduct savings bond interest if they use that interest in principal for higher education purposes. So not everybody gets to use that. Your adjusted gross income has to be under a certain amount in order to take advantage of that. And that happens a lot throughout the tax code and throughout the tax return. We see all sorts of things that are different deductions and credits that are limited by the amount of adjusted gross income. So this first classification of deductions, which like I said, we call them adjustments, are what we're going to discuss today. They're special in that they reduce that adjusted gross income. So that means that if you have certain items that are adjustments that bring your adjusted gross income below a threshold, you're going to get to take advantage of certain credits and deductions. If you don't have those adjustments, you're not going to get to take advantage of those certain credits and deductions. So these are special in that they do affect the adjusted gross income. The other deductions that we're going to talk about starting in chapter 5, they do not affect adjusted gross income. So even though they're nice, they reduce, those other deductions reduce your taxable income. They aren't going to also give you the benefits of other credits and deductions. So they're not going to do anything for you in that respect. But these both reduce your taxable income and can help reduce your adjusted gross income to a point where you can take advantage of an additional credit deduction. So they may give you a double whammy, a double benefit in essence. So they're special. They're nice. You want to take advantage of them if you are eligible to do so. And so these are the adjustments that we're talking about. They all show up on page 2 of the Schedule 1. So we're going to be adding another schedule. So far, we've really only looked at the 1040, page 1 and 2. Now we're going to be adding, well, I think you did have a tax return problem. You had a tax return problem that added a child tax credit to it. I'm sorry about that. I apologize. That added a complication that you really didn't need at this point. But you also, I think, had a tax return problem that did have some unemployment compensation, so other income that was on the Schedule 1. But what we're talking about here, that was page 1 of the Schedule 1. What we're talking about here is page 2 of the Schedule 1. So these are all reductions, items that reduce our taxable income. So that's what we're going to go through here. And the first one we're going to talk about is student loan interest. So this is one that most students are interested in, student loan interest. So a lot of students are, their ears perk up a little bit because even if you're not dealing with it right now, you may be dealing with it at some point in the future when you have to pay back your student loan and you're paying interest on that student loan. So there are rules and there's a phase out. So there's a phase out for student loan interest. So even these adjustments, some of them are based on adjusted gross income. So we have to do a little bit of fancy footwork because otherwise we've got a circular, what do they call that? Circular reference. Yeah. But we have some special, we're going to talk about the rules for deducting student loan interest. We're also going to talk about the health savings account deduction. We talked about health savings accounts a little bit in payroll accounting. A certain type of special savings account where individuals can put money in, and then if they use that money, they get a deduction when they deposit the money, and then it's also tax-free when they withdraw it, as long as it's used for health purposes. So we'll talk about those rules. Military moving expenses, that's another item that's one of the adjustments to adjusted gross income. Self-employment taxes. So you remember we talked about those as well in payroll accounting. So the self-employment taxes, that 15.3% that those privileged enough to be self-employed get to pay. There's also a deduction for half of those self-employment taxes. So even though you're paying the tax, you then get to turn around and deduct half of it. That's what we're referring to here. Self-employed health insurance deduction. This is only, again, for individuals who are self-employed, and there are special rules surrounding who gets to take that deduction. But for individuals who are self-employed and meet the requirements, they get to deduct the amount that they pay towards health insurance. Penalty on early withdrawal of savings. When we were talking about interest income, we looked at the 1099 INT, and I pointed out that there was a box for penalty on early withdrawal of savings. That's what we're referring to here. So that's kind of a very short discussion, but that's one of those adjustments as well. Alimony. So if for individuals who are divorced, who are required to then pay their ex-spouse, not child support, but alimony, in certain circumstances, that alimony payment can be considered a deduction, an adjustment. On the other side of that, if that is the individual receiving the alimony, if that alimony qualifies as a deduction for the payer, the payee for the payee is considered taxable income. We've got those two sides to every equation. If it's income for one, it's the deduction for another. If it's the deduction for one, it's income for another. So the alimony, but you'll see that rule changed a few years ago. It doesn't apply to as many people as it used to. And then we have a deduction for educator expenses as well. So we'll define what exactly an educator is and what that deduction is. This is only a partial list. If you look at the Schedule 1, and in fact, let me pull it up real quick. I'm going to pull up the Schedule 1 so you can see what we're talking about here. Oh, shoot, I don't have my... Hopefully I could be heard. Let's see. All right, so as I was saying, so the Schedule 1 has two parts to it. The first page is other income, so additional income. So this is where that unemployment compensation went that you put in on one of those tax return problems. Page 2, these are our adjustments. So we're going to talk in this chapter about educator expenses. So line 11. We're going to talk about line 13, health savings account deduction. We're going to talk about moving expenses for members of the armed forces, line 14. We're going to talk about line 15, the deductible part of self-employment tax. We are not talking about self-employed, SEP, simple, or qualified plans. These are retirement plans. We are going to talk about self-employed health insurance, so line 17. We're going to talk about line 18, penalty on early withdrawal of savings. We're going to discuss alimony paid, so line 19, and you'll see there, line 19A, there's three parts to it. Not only the amount of alimony paid, but the social security number of the person receiving it. That's so the IRS can check their tax return and make sure they claimed it as income. And then the date of the divorce, and this is why I said the rules changed. That's why the date is important there.
We're not going to talk about the IRA deduction. I wish they would add that into this chapter, but they don't. So the IRA deduction, this is an individual retirement account. So individuals who are not covered by retirement accounts through their employer can make a contribution to a private individual retirement account. There are limits for that as well. That would be on line 20, but we don't discuss that. The last thing, actually the first thing we're going to discuss is the last thing on here, student loan interest. So line 21 we're going to look at. We're not going to talk about reserve for future use. Some other adjustments, you can see there's a lot of different items here and then there's a spot for anything else that qualifies but doesn't have a line on it. So those are the ones that we're going to talk about here in this chapter. Everything is totaled up and entered on line 26 of the Schedule 1. And then enter here and on Form 1040, line 10. 1040, where's my 1040? What's that?
The one right there.
That's a Schedule 1, yeah. Let's see. Oh, that's just Schedule. I don't think I have 1040 open either. Let's find a 1040. I should just open these up. All right. So, and then it's totaled up and then entered on, where are we? It's 2020. Oh, it's 2014. Look how it's changed. That's why I was like, what? Wow. All right. 24. There we go. So line 10, adjustments to income from Schedule 1, line 26 goes there, right? So when you're doing your tax return problem, that's what you're going to be, those are the lines you're going to be looking for. So first off, let's talk about student loan interest. I would like to get through, well, I'd like to get through half of it, 4.4 today. That would be good. There we go. All right, so student loan interest. So if you paid qualified higher education expenses to a qualified higher education, a qualified university or college, qualified provider of higher education, and you took out a loan for the purposes of paying for that education. When you pay back the loan, you're paying interest as well on that amount. You may be able to deduct the interest up to certain limits. So who can take the deduction? So an individual can take a deduction for an amount equal to the interest paid by the taxpayer during the taxable year on any qualified education loan. Only the person legally obligated to make the payment can take the deduction. A person who is claimed as a dependent on another person's return cannot claim the deduction. So if you are, if you're claimed as a dependent on parents' return or somebody else's return, and you're paying student loan interest and you have to file your own tax return, you do not get to claim the student loan deduction. And people whose filing status is married filing separately as well cannot claim that deduction. So that's another one of those disadvantages of the married filing separately filing status. But it's only the person who is legally obligated to make the payments can take the deduction. So even if you're a really super nice person and you're helping to make payments for your kid or your grandkids or something like that, if you are not legally obligated, you don't get to take any deduction for that payment. So we've got here Gabriella borrowed $5,000 for college on a qualified student loan. In 2024, when she began making payments on the loan, she was still living at home. And her parents claimed her as a dependent. In that case, Gabriella cannot claim the student loan interest deduction because she's a dependent on somebody else's return. Even though she was legally obligated, she was the person legally obligated and she paid it, she still cannot claim it because she is a dependent on somebody else's return. So the deduction is limited to $2,500 per year. That's per return. So if you're married filing jointly, the limit is still $2,500, even if both couples are paying back on their student loan. So that's still a marriage penalty that exists within the tax code. It's also can be further limited based on modified adjusted gross income. So there's that term, and we'll talk about how it's modified. They talk a little bit about the student loan repayment pause. I guess that restarted again October 2023. Or wait, no, it started, when did it start back? Oh, ended on September 30th, 2024. That's kind of an aside. So what is a qualified education loan? It has to be a qualified education loan. It was incurred by the taxpayer to pay for qualified education expenses on behalf of the taxpayer, taxpayer's spouse, or any dependent of the taxpayer at the time the loan was incurred. So the loan must be solely to pay for educational expenses. So you can't take out a home equity loan that is also used for, so say you've got a $50,000 home equity loan and you take out $10,000 to fix up your bathroom and then you take out $10,000 to pay for your kids' college. That is not considered to be a qualified education loan. The loan has to be solely to pay for educational expenses. Home equity loans, revolving lines of credits often do not qualify. So qualified education expenses must be paid or incurred within a reasonable period before or after the loan date. So they meet that test if the proceeds of the loan are dispersed within 90 days of the start or 90 days after the end of the academic period. So that's to stop people from taking out a student loan for other purposes, right? So it has to be within a certain time frame. The expenses has to occur during the period that the recipient was carrying at least half the normal full-time workload for the intended course of study. So you have to be at least a half-time student. Can be undergraduate, graduate, that's fine, either one. So what are the qualified education expenses? Those are the costs of attending an eligible education institution, include tuition, fees, books, supplies, equipment, room and board, that is included as well, transportation, other necessary expenses of attendance. You have to reduce your qualified expenses by the amount of income that was excluded from gross income in each of these cases. So if you received, if your employer helped to pay for your education, you've got to subtract that amount because it was excluded from your income. If you redeemed those U.S. savings bonds in order to pay for education, you've got to exclude that. You already got the tax benefit of that. You don't get then a double benefit of excluding the interest on student loan costs. So this is for the education expenses that are being paid. So all of these things, any qualified scholarships and fellowships as well. So for example here, LeBron spent $3,000 on qualified educational expenses. He received a loan for $2,800. Okay, so he had $3,000 of qualified educational expenses, had a loan of $2,800. During the semester, he received a scholarship of $500 that he didn't have to pay any tax on. It was excluded from income. So now what that does, that $500, we got to subtract that from the $3,000. And that brings his qualified educational expenses down to $2,500. As a result, the interest on $2,500 is eligible for deduction. But the interest on the remaining $300 is non-deductible personal interest. That makes it kind of difficult to calculate, especially if you're paying back student loans that you incurred 20 years ago and trying to remember. In practice, most people will just take all of that student loan interest because, they won't go through all of these gyrations. In practice as well, most people, the student loan, because it's $2,500, that's a smaller amount than what they actually paid in student loan interest anyway. But just kind of an aside there that sometimes that's not a practical calculation. So other limitations. So you have to attend an eligible educational institution. What does that consider? Essentially, it's if you can get a student loan through that if you can get financial aid through that institution, then it's a qualified institution for purposes of the student loan deduction. So it would also include lots of trade and technical schools as well. I mean, there may be some, so like if you're going to school for real estate, something like that's probably not a qualified institution. It just comes down to if you can receive federal financial aid, then it would be qualified. Let's see. So the deduction, like I said, is limited based on modified adjusted gross income. So what is our modified adjusted gross income? It starts with our adjusted gross income. So whatever's in that box for adjusted gross income. Remember, that's coming after all of these adjustments. That means we're going to have to add back. In the adjusted gross income is going to include our student loan interest. So we're going to have to add that back. That's our first adjustment. We've got to add that back so that we get rid of that circular reference, right? So we've got to add back our student loan interest if our number doesn't already exclude it. If we had any foreign U.S. territories or Puerto Rican income excluded from taxable income, that may be if we have some municipal bond interest that we accurately excluded from so like municipal bonds, we got to add that tax-exempt interest back in. And if we took any deduction for tuition and fees. Like I said, this doesn't even exist anymore. I'm not quite sure. I'm still not quite sure why they have it in here. There must be a reason that I'm just not aware of. So what do? The deductible amount of student loan interest is reduced when modified AGI reaches $165,000 for a joint return, $80,000 for single, is totally eliminated when it reaches $195,000 or $95,000 for single. So this is our phase out. This is our student loan interest. So for single, from, what did we get, 80,000 to 95,000. And you'll notice that's a $15,000 range. This is our phase-out range. Married filing jointly, and single is, let's see. It's also for head of household as well. So, and remember, married filing separately doesn't get to take student loan interest, so we don't have to worry about that if they're married filing separately. So this one is 160 to, did I get that right? 165. Usually it's double. 165 to 195. Okay. So they just added 100,000. Well, no, not added 100,000. It used to be double. That's different. So here we've got a $30,000 range. So if your income, based on your filing status, is below this amount, then you are entitled to 100% of the student loan interest that you paid up to $2,500. So if you paid $3,000 in student loan interest and you're single and your modified adjusted gross income is $75,000, your deduction for student loan interest is $2,500, even though you paid $3,000. $2,500 is the most you can take. If your income is above these amounts, you get zero. Zero. You do not get anything. if your income, your modified adjusted gross income, falls within this range, then there's a calculation for determining how much you get. But so there are two limitations here. There's the $2,500. You cannot take more, you cannot get more than $2,500 of deduction from this. And based on your adjusted gross income or modified adjusted gross income, you may have another limitation, or you may get nothing. So let's take a look at this. What you do is you calculate the preliminary deduction. So whatever deduction that you would ordinarily get before calculating any phase out, you take that and then you modify it by this fraction. So for married taxpayers, what it is the modified adjusted gross income minus this top number, so the top of the range, divided by the range. So for single, what we'd be looking at is modified adjusted gross income minus 95,000 divided by 15,000. For married filing jointly, again, modified adjusted gross income minus 195 divided by 30,000. What we're calculating here is the amount of interest that is disallowed, not allowed. So in order to figure the allowed amount, you're going to have to subtract that from the preliminary deduction. All right, so let's do this here. Let's say we've got somebody let's say they have, let's make it easy here. Let's say they're single. The modified adjusted gross income, so we've added back the student loan deduction, is 90,000. And their student loan interest is 1,800. So what we're going to do is we're going to take the 1,800, that's our preliminary deduction, times, and then we're going to do this, modified AGI, 90,000. Oh, I'm sorry, it should have been the bottom of the range. Did I do that right? I didn't do that right. I put the top of the range, it should be the bottom of the range. Sorry. So it should be like the modified minus 80,000, sorry, times over 15, or modified AGI minus 165 over 30. My bad. I put the top of the range. It should say the bottom. It should be the bottom of the range. Everybody get my correction there? So you're going to use this number, not this number. I gave the wrong one. All right. So let's fix that there. So 90,000 minus 80,000 divided by 15,000. All right, so we've got, what, 10,000 divided by 15,000? %. So 1,800 times 0.67. My boys would be just delighted to see that. So 1,800 times 0.67, 1,206. So this is the disallowed, which means our allowed amount is going to be 1,800 minus 1,206. So the difference, what do we have here? 794. Is that right? No, what am I doing here? 594. Allowed. So 594 is the amount of deduction that we get. Let me do another one. So let's say married filing jointly. Modified adjusted gross income is 178. Student loan interest is 7,300. Well, our preliminary deduction cannot be higher than 2,500. So even though we paid $7,300 in student loan interest, the fraction that we're going to have to calculate, or the amount, the allowed amount that we're going to have to calculate, is going to be based on 2,500. So this is what our calculation is going to be: 2,500, not 73, times our modified adjusted gross income minus 165 divided by 30. Essentially, this fraction is the fraction that we are into the phase out range, right? So if it was like right smack dab in the middle of that fraction, if it was that 170,000, our fraction would be 0.5, right? So 50%, because we're 50% into that phase out range. So that's what that calculation is. All right, so 178 minus 165 is 13 divided by 30. So 43%. So now we're going to take 2,500 times 0.43. I know that's 0.433333 times 2,500. So 1,075. This is the amount that's disallowed. So we're not done yet. We have to then take 2,500 minus 1,075, which, what is that, 15, 14, 25? Is allowed. That's the amount of the deduction. Even though we paid $7,300 in student loan interest, we are first reduced to $2,500, and then because of our modified adjusted gross income, we are further reduced. So we can only take $1,425 in student loan interest. The same thing here. Shannon and Marion borrowed $30,000 in qualified educational loan to pay for higher education for their kids. They paid $1,800 in interest on the loan. Their modified AGI is $185. They're entitled to deduct $600. So they take the $1,800, what they paid, the modified AGI minus the bottom of the range, so $20,000 over $30,000. So 2/3 is disallowed. They're only going to get to take 1/3 of what they actually paid. So they get $600. Don't forget this last part. Okay, don't forget this last subtraction. It's really easy to just stop here and say, oh, they get 1,075. That's not true. You got to subtract, because that's the amount that's disallowed that you're calculating there. I won't go through that. The calculations went. So maybe some of you are already familiar with this form, maybe not. So this is a 1098E. This is the form that lenders send out at the end of the year to indicate how much student loan interest they have received from that borrower. So, and that goes in box 1 there. So that's the amount you kind of start with. If that's over 2,500, you're not going to get more than 2,500. 2,500 is the most you're going to get. If you got 14 of these, they all add up to $10,000. Doesn't matter, 2,500 for all of it. What else do I want to say? So student loan, you had asked Anthony about student loan forgiveness, I think. Was it student? Yeah. So, and here it says, so American Rescue Plan, tax years 2021 through 2025, so we're still there. Any discharge of student loan debt for any reason, including private student loans, may be excluded from taxable income as long as there's no provision for the student to provide services to the lender. So, yeah, you can probably ignore that last part. So it goes through 2025. Starting 2026, any amount that's forgiven will be considered forgiveness of debt and will be taxable unless you're considered to be insolvent. All right, questions?